Let me say something controversial right at the start. Manual budgeting is dead in 2026. Not hard, not boring, dead. If you're still opening a spreadsheet every Sunday night trying to categorize Uber Eats under dining instead of regret, you're basically doing financial archaeology. The average American in 2026 isn't dealing with just rent and groceries. We're dealing with $2,400 average rent in major metros, $600 to $900 car payments, streaming subscriptions multiplying like rabbits, buy now, pay later installments hiding in plain sight, and dynamic pricing on everything from flights to concert tickets. The financial system is automated. Your expenses are automated, but your decision-making is still manual? That mismatch is why so many people feel broke even with decent salaries. So I did something extreme. For 30 days, I let an autonomous AI agent manage my entire salary. Every paycheck that hit my account was immediately analyzed, allocated, moved, negotiated, and optimized by AI. Not just tracked, managed. This wasn't a budgeting app that politely shows you a pie chart. This was agentic AI finance in action. The goal was simple: achieve financial sovereignty without obsessing over every dollar. In other words, could I build a system of zero-effort budgeting that outperformed my own discipline? Here's exactly what happened. Before we talk results, let's break down the actual AI ecosystem that powered this experiment. This wasn't one app, it was a coordinated AI stack. Copilot Finance. Copilot Finance in 2026 isn't just a budgeting dashboard, it's a predictive financial modeling engine. Once connected to my checking, savings, credit cards, and investment accounts, Copilot didn't just categorize transactions, it built a behavioral profile. It analyzed 12 months of historical data. It identified patterns like how my dining spikes on Fridays, how travel expenses cluster around certain seasons, how my utilities fluctuate in winter, and how my Amazon spending increases after 9 p.m. Then it created forward-looking cash flow projections. It could tell me with 90% confidence what my checking balance would be 14, 21, and 30 days from now based on recurring charges and behavioral probabilities. Instead of asking, "Can I afford this?" the AI asked, "If you make this purchase, what does your liquidity look like 3 weeks from now?" That shift from reactive tracking to proactive forecasting changed everything. Origin. If Copilot was the behavioral brain, Origin was the strategic command center. Origin aggregates not just bank accounts, but investment portfolios, retirement accounts, debt balances, and tax exposure. Its AI engine evaluates net worth growth rate, risk-adjusted returns, debt interest drag, and opportunity cost of idle cash. When my paycheck hit, Origin's AI evaluated 4 things instantly: liquidity buffer requirements based on historical volatility in my expenses, expected return from investing excess capital, guaranteed return from paying down higher interest debt, and short-term savings goals like travel or upcoming large purchases. It didn't just say, "Move money to savings," it ranked the best possible use of each marginal dollar. That's not budgeting, that's capital allocation. Rocket Money's AI Negotiator. Then came the most underrated weapon in this entire stack, Rocket Money's AI Negotiator. Most Americans underestimate how much money leaks through fixed expenses: internet, cell phone, insurance, streaming bundles, gym memberships. Rocket Money's AI Negotiator doesn't just detect subscriptions, it analyzes market pricing for similar services in your zip code. It identifies when you're overpaying relative to regional averages. Then it automatically initiates negotiation requests or suggests switching providers. In my case, it renegotiated my internet bill from $89 per month to $62. It flagged an outdated insurance policy that I hadn't reviewed in 2 years. It canceled a forgotten software subscription that was charging $19 per month for a service I hadn't used in 9 months. This is where agentic AI finance feels less like budgeting and more like hiring a financial operations team. Week 1 was surgical. The AI conducted a full expense audit.
Not just subscriptions. It analyzed recurring merchant names, transaction frequency, and merchant category codes. It identified 14 recurring subscriptions totaling $312.47 per month. 7 were immediately categorized as redundant or low value based on usage frequency and overlap. But the AI went deeper. It calculated annualized impact. That $312.47 wasn't just $312. It was $3,749.64 per year. That framing hit differently. After cancellations and renegotiations, my new recurring subscription cost dropped to $130 per month. That freed up $182 monthly. But here's the psychological shift. Because the AI executed the cancellations automatically, I didn't experience the emotional friction of, what if I need this later? Zero-effort budgeting removes hesitation. Week 2. Intelligent High-Yield Savings Automation. Week 2 was about liquidity optimization. The AI determined that my typical monthly fixed expenses were $3,850. It calculated that maintaining a $3,500 checking buffer gave me 1.1x expense coverage for short-term volatility. Anything above that threshold was considered inefficient capital. When my second paycheck hit, the AI moved $1,200 into a high-yield savings account, earning 4.9% APY. 3 days later, it moved another $650 because my projected 30-day cash flow showed surplus. By the end of week 2, $2,450 had been transferred automatically. Normally, that money would have remained in checking, earning near zero. This is where financial sovereignty becomes real. You're not restricting spending, you're optimizing idle capital. Week 3. AI-driven investment rebalancing and tax strategy. Week 3 shifted from saving to wealth building. Origin's AI analyzed my portfolio allocation. I was 72% equities, heavily weighted in U.S. tech ETFs. Only 8% bonds, minimal international exposure. The AI assessed volatility exposure relative to my income stability and age profile. It determined my portfolio risk exceeded my stated tolerance by 11%. So it rebalanced. It reduced concentrated tech exposure, increased diversified bond allocation, and boosted international ETFs. It also scanned for tax loss harvesting opportunities. One underperforming ETF position showed a $620 unrealized loss. The AI harvested that loss strategically, allowing me to offset future capital gains. This wasn't emotional investing. This was algorithmic discipline. The drama, when the AI got it wrong. Now here's where it got interesting. During week 3, the AI flagged a $480 charge as a non-essential spending anomaly. It temporarily blocked the transaction. The issue? It was a deposit for a professional headshot session tied to a long-term career move. The AI saw pattern deviation. It didn't see career ROI. For 6 hours, I couldn't access those funds. I had to manually approve the transaction and whitelist the merchant. That moment reminded me that AI optimizes for patterns, not ambition. Agentic AI finance still requires human oversight.
Now, let's talk numbers. In my previous manually managed month, I saved $640. In the AI managed month, here's what changed. Subscription and bill reductions saved $182. Reduced impulse spending compared to historical average saved $530. Automated transfers into high-yield savings totaled $2,450. Net savings for the AI month came to $3,180. That's nearly 5 times higher than my human-managed month. Even adjusting for one-time effects, the behavioral shift was undeniable. Is AI finance safe? If you blindly surrender control without guardrails, no system is safe. But if you define boundaries, spending thresholds, liquidity minimums, and approval alerts, AI becomes an execution engine. The real question isn't whether AI can manage money, it's whether humans are good at consistently managing complex financial systems under stress. High rent, inflation, subscription creep, lifestyle pressure. Willpower doesn't scale. Systems do. After 30 days, I'm convinced that zero-effort budgeting powered by agentic AI finance is the future, not because it replaces intelligence, but because it enforces it. Financial sovereignty in 2026 isn't about tracking every dollar manually, it's about designing a system where every dollar has a mission the second it lands. And if the last month taught me anything, it's this. The biggest upgrade to your financial life might not be earning more, it might be delegating better. So here's my question for you. Would you trust an AI to manage your next paycheck? Because after seeing these results, going back to manual budgeting feels like trying to compete with a calculator using mental math.